Let's bring it closer to home and the fact that we are the largest central bank on the African continent. What inroads are you making to partnerships with other countries on the continent and central banks in those respective territories?
You know, the South African Reserve Bank has had a long working relationship with our colleagues, and there are a number of structures that are pretty effective. For instance, we've got a common monetary area. A few weeks before any MPC meeting, the four of us as governors meet. We look at the economic conditions in all countries. We explain our own circumstances so that there's an insight from by our colleagues into our own situation. So that we share information that gives us a better understanding of what measures we take, how it impacts on our neighbors. So we see ourselves as very much a part of building a region of if you like, a common platform and understanding and working together.
What is the biggest risk to continued economic growth in South Africa, in your opinion?
It would be hard to pinpoint one, and I think we have a number of very big challenges. The first will be what happens in the world, because we are a commodity producing country. Commodities are demand if there's growth in other countries. The benefits, if you look at Asia and China, that is certainly very good in terms of the signals being sent. Expectations is that China would grow at about 9.6% this year. And again, a regional readjustment, if you like, where given what's happening in other parts of the world, China, Singapore, Malaysia, Thailand, are working together to look at how they create a regional economic growth, and they're doing extremely well. India certainly is looking very positive. Brazil certainly is an extraordinary story. So in that sense, we've got a lot of interaction and outlet that bodes well for our growth. But as we discussed earlier, the situation in Europe is, and they are a major trading partner for us, is very limited in terms of what the outlook is there. So it does depend on what happens, including not just if we have steady, even if slow growth, but if you do get Greece unresolved and so on. So these are huge risks. And as I said earlier, the level of fiscal deficit throughout the country. Domestically, I think it is about assessing what we need to do. Our biggest risk is high levels of unemployment, a disproportionate fall in the number of people, a disproportionate rise in the unemployment rate, given the nature of our economic impact and the brief recession that we've had, although it was quite steep, to the number of people that ended up being unemployed. So I think unemployment is very important factor.
But
for
our
us.
fiscal deficit at what now 6.8%,
Yeah.
under control in your opinion?
Absolutely, I think that there's certainly for us an approach to the fiscal deficit and to spending in a counter-cyclical manner. Very good measures taken, and I think a very sober approach by the Minister of Finance. So that isn't a concern for us. Obviously, the question of fiscal and monetary policy and how that works together is important. And then the key questions of getting things working at the micro level as well is very critical.
The Rand, and looking at the Rand and the impact that Rand strength purportedly has on economic growth and employment. There's the other side of the coin, where people say that a country's currency is the country's share price, and that a stronger currency needs to be celebrated as a result of that. Is there a case to be made that we need to become more competitive with a stronger Rand?
Look, they are huge. I don't think there's differences of view about, well, there probably are differences of view about the extent to which the Rand is overvalued or undervalued, and many people saying that it's overvalued at the moment. But you need to recognize some of the factors that are causing that. You've got weakening dollar, so it's Rand-dollar weakness as well. You've got a situation of the differentials. If you look at our interest rates and what you can earn in South Africa compared to what is in the developed world, you've got walls of money looking for yield, and therefore huge inflows. If you take South Africa year to date, we've had about a 35 billion Rand net inflow. Last year for the year was about 90 billion Rand inflow. In 2008, in the second half of the year, you had over 70 billion Rand outflow. And the consequences, the Rand and the exchange rate tracks these developments. And if you have interest rate levels staying low for a long time in the developed world, you'll still have you know, everybody looking for yield, investors looking for yield. So
but is there anything that you can do about those foreign inflows? I mean, if you look at Brazil, and I mean, the real was the best performing currency in 2009, and they've put a hot tax onto foreign investments.
But does it work?
And well, that's exactly what the question is.
The question is, and they're asking the same question, I must say. But the second question is you've got to look at the size and the depth of our market, which is different from other emerging markets as well. We've got a very well-developed market. So the spot market in which the exchange rate is largely determined has an average daily turnover of about $3.3 billion US. So if you want to, say, intervene in the currency, the scale of that intervention has to be huge given the size of the market.
So it's not an option for the South African Reserve Bank to intervene in the currency?
The question that we're raising is that when you look at these things, there's no simple answer. We know what the issues are. There's not a simple answer to them. So as I'm saying, if you look at the size of that market at 3.3 billion daily turnover, you're going to have a situation that says, okay, we've got a total reserve of $42 billion. We have different choices to a China that in the last quarter thought it had a slow reserve build-up when it increased its reserves by $47 billion US. So they have different choices. They have different savings ratios. You know, we have very low savings ratios, as you know. So the issue, there's no question that that the rand is a factor. But the answer and what you can do is not so simple.
Do you have any concern about interest rates going lower from these levels if the need be? I mean, we're sitting at 6.5% on the repo, which is the lowest level we've seen since inflation targeting was introduced.
I don't think one should just simply look at the nominal level. It's the real level. The real interest rates are around 1%. And to me, it's not about a concern about being lower or higher. It is what does the data tell you that is there and what is possible to do. So we shouldn't look at it in those absolute terms. It depends what happens with inflation, depends what happens with the currency, and the ability to weigh that up. And again, it's a forward-looking approach. It's not a retro-looking approach. You've got to look and say, what are the implications down the line? At the moment, inflation looks like it will stay within the target range for the forecast future, which is this year and next year. The more you're in the target, the more room you've got to move on other things. When you're not in the target, you have less room. So for me, it's not about do I have misgivings about any of that. It's what is the data telling us? What are the options that we have in a forward-looking manner? Where is this taking us to, and what do we see on the horizon? We have better information at this point, given the decision around Eskom, but we have real concerns about the growth of administered prices. So there are huge risks globally. There's huge risks domestically, and it's weighing all of these things up to try to come to a sensible, reliable way of dealing with this going forward.